a Bloomberg reporter called me in New York for a comment on a story that he was crafting. He and his colleagues had already interviewed, I think, 21 of 181 signatories, the original signatories of the Business Roundtable statement. And a pattern was emerging. Those interviewed, though they thought the statement fairly captured what they thought of their roles and responsibilities. In fact, the reporters were told that it was easy to sign on because nothing would really need to change. The signatories felt they were already attending to the needs of their so-called stakeholders. Yet in the American public markets today, over 90% of profits are paid out to shareholders in the form of dividends and share buybacks. And if you add in debt-financed share buybacks, the percentage grows to something like 130% of profits. So while the winds of change are unquestionably now felt in boardrooms and classrooms, in the executive and clearly in the public square, I think the scaffolding of shareholder primacy to some degree is still in place. Shareholder primacy is powerful in part because it's simple, a single objective function that is both easy to reach, teach, and easy to measure. But single objective functions never end well. Behaviors like earnings management, underinvestment in infrastructure, tax avoidance, and outsized CEO pay packages linked to total shareholder return, plus a stew of stagnant wages, self-dealing in Washington, and decades of delay on climate have produced a pretty resounding chorus of discontent and demand for a new governing ethic. So how do we really leverage this moment? What might this mean? What are the steps that can turn a bold move and a call to action by the Business Roundtable into a moment of real reflection in boardrooms and in the executive suite? First, I think we need to unpack the word stakeholder. And we need to understand that the signatories who say nothing needs to change are confusing important community-spirited activities and good works with the underlying decision rules and values that determine how to allocate capital in order to put the health of the society at the center. But when the system is truly at risk, which it is in countless different ways, from climate to inequality, you simply don't solve this one company at a time. And so I think what we're really seeing emerge is an era of co-creation, where the smart companies will know that they're going to need to collaborate with others to move the needle. And that does bring us back to some of these coalitions, which are important change, but they don't negate the need to look at the underlying decision rules, governance, policies, regulation that continue to keep the shareholder at the center.
So having spent the last 15, 16 years serving on a number of different boards, and then in 2018 also becoming the chair of the Institute of Directors, I have been quite closely observing the shift that has happened over especially the last 15 years. The conversations in the boardrooms has absolutely changed. So to really affect change happening, you generally need a sense of urgency paired up with a powerful coalition that pushes for it. So powerful coalitions can be many different things, but for many businesses, it is one way or the other, they're stakeholders, right? And in my world, stakeholders effectively of all organizations is everybody. The ultimate stakeholders are the people in the world and the planet we live on, because no people, no businesses, right? I mean, it's really quite simple. And if we stick to the simple thoughts around why is it that we can't just look after shareholders, actually, because there is no value for shareholders if there's no people in the world. If there's no laws, no infrastructure, all of these things are completely interwoven with anything an organization does, whether it's a FTSE 100 listed company or a membership organization like the IOD, no members, no IOD. So the focus away from just shareholders to stakeholders is absolutely there because we've been forced in that direction. It would have been nice if we have led that as leaders and had been clear enough of who our key stakeholders are, that shareholders is just one of many stakeholders, right? But that is unfortunately not how it works, especially in a world of capitalism. Well, if we move a bit over from sort of capitalism to valuism, I would say that then we start seeing the broader values. I mean, what is value? It is not just the bottom line, because the bottom line is dependent on so many other people being happy. So when people are not, or when we say or do something that is not popular, we get punished, and it's a very fast punishment we receive. So therefore, it is absolutely part of the discussions today. So as it said in the description of the event, businesses is a set of relationships between stakeholders. And I think many of the businesses have absolutely seen and felt that. Certainly the businesses I've been serving and working with in different ways have noted that and have felt that at times, that if we are not very clear of that whole broader stakeholder engagement and management, then we lose out. So within governance, the key things for me is to ensure that you understand who all your stakeholders are, you manage them appropriately, you communicate with them, you are concerned with what they are concerned with, and you understand what they're concerned with through talking to them and through seeking feedback from them, so that you know where they stand on issues, should you not be fully clear yourself on rights and wrong. But the world is going very much towards what is right and what is wrong, where people uphold, a proper purpose for a business, but they also uphold certain values.
Our policy priority stated is to promote long-term investment perspectives and sustainable value creation and preservation. And I'd like to sort of begin my remarks by sort of drilling down on two key concepts. Firstly, what do we mean by sustainable value creation? And secondly, the concept of investor fiduciary duty and how this should guide this debate. And these two concepts are interrelated. Sustainable value creation is a bit of a loaded phrase. There's a bit to pick apart. But I think it's fair to say that sustainability in the investment world, you've noted already that the growing focus on so-called ESG, or the increasing focus on how environmental and social issues can and should link to the investment process and value creation process. And this requires both the understanding of the role of key stakeholders, such as employees, customers, supply chains, communities, civil society, and all of these are critical to sustainable value creation, and I'll be getting back to this point. This also, I think, is related to this, also requires us to focus increasingly on issues of systemic risk. This could be climate change, pandemics, income inequality, risks that affect us all as professionals as well as individuals. And I think it's important to see that these issues affect not only the quality of the individual companies that we invest in, but also the quality of markets, economies, and society more broadly. Now, I think both sustainable value creation and investor fiduciary duty are relevant to today's discussion. I think aptly named the false dichotomy, and that's my discussions with Paul Barnett sort of drew me into this debate, and really it sort of, in the extreme, it can be sort of a debate on what some people might frame as shareholder primacy versus stakeholder primacy. And I'm sympathetic with putting this debate on the table. And as a representative of an investor body, you might think that my allegiance might be to be as a red-blooded shareholder primacist in this concept, or to maybe distort the Trumpian view of the United States, shareholders first, or make shareholders great again. But that is not my take. For starters, I think that when people use primacy, I think that the use of that word unto itself is a bit dangerous. And I think it's subject to extreme interpretations. And I think it's unfit for purpose in this debate. But I would like to talk about why investors can and should be concerned with stakeholder interests, and how this is ultimately compatible with investors' fiduciary duties, again, particularly for investors with long-term horizons. But if there's to be any primacy, I would argue that we should really think in terms of primacy of the enterprise itself, or company primacy, focusing on the long-term resilience and sustainability of the company. And to do that will require companies to generate fair and adequate returns for shareholders. Again, generating a pension income and retirement income for people is a social good. But while at the same time, responsibly understanding the legitimate needs of key stakeholders who are fundamental to this type of value creation taking place in the first place. And as I'll explain, I think that this is not a question of maximizing this or that. I think it's ultimately a question of seeking a sustainable multi-equilibrium between all members of the corporate ecosystem. So I think both sides, the shareholder and the stakeholder side, they both have their logic and they both have their appeals to certain audiences. And it's almost as if one feels required to pick a side. In a British context, are you for Man City or are you for Man United? But I think that this is the temptation to pick a side in this debate is really the nature of the false dichotomy, because in extremis, shareholder primacy, as we've heard, can be myopic. It could lead to short-termism at the expense of longer-term economic and societal interests, and can lead companies down the road of exploiting externalities in the pursuit of seeking economic rents or above justifiable profits to the disadvantages of stakeholders' interests in society largely. And I would argue that this is not sustainable behavior, and I think many institutional investors would agree with that. On the other hand, taken in extremis, stakeholder primacy can also be questionable. Council of Institutional Investors, a very strong investor body in the United States, would argue that accountability to everyone means accountability to no one, and that the net effect could be to diminish shareholder rights and to marginalize shareholders' voice without establishing a credible alternative mechanism to hold management accountable.
So much work has already been done in understanding what our needs are, and a lot of work has been done in relating our needs to various stages of development, whether we're talking about individual, organizational, community, or national development. This work's reflected in practice in the Sustainable Development Goals, for example. So meeting the needs for sustainability is a way of creating real value that offers great potential for businesses that are able to design business models to satisfy basic needs for sustainability profitably. C.K. Prahalad explained years ago the fortune that was to be made from the bottom of the pyramid, but many of those needs remain unmet today because of the challenge of working out the kind of business model that allows those needs to be met profitably. But creating value doesn't only mean satisfying basic needs, and sustainability, I would argue, shouldn't be our goal anyway. I think sustainability is just a necessary step in the journey towards achieving our larger goal. So I would define value creation as contributions to sustainable, widely shared prosperity, measured in terms of human flourishing and well-being. And it's not a new idea. Aristotle called it eudaimonia. I'm going to refer to history to make this real. So in the 18th century, enlightened thinkers with a very strong set of values decided to harness science and technology to improve the human condition. Most were members of a few religious groups who shared a vision. Their vision was the creation of heaven on earth, And the most famous one of these religious groups was the Quakers. They went on to be the leading pioneers of the first industrial revolution. And these Quaker industrialists, as they are referred to, were also extremely successful capitalists, driven to create value by meeting the real needs of society. I think today we would say that they accepted their corporate responsibility. They were good corporate citizens. They created great businesses and great reputations. They created businesses that people wanted to work for, supply, buy from, and many of them remain well-known household names. So I think the Quaker industrialists demonstrate one thing very well. Their enlightened thinking demonstrates that businesses that are managed for the long term, that create value for all stakeholders, also ensure shareholders are extremely well served. They created flourishing businesses, they created flourishing communities, they created a flourishing economy. The Industrial Revolution produced the longest period of increases in prosperity in the history of mankind. So I think the achievement is one that we ought to learn from as we look to what needs to change going forward. In my opinion, I think the example I've just given you is the clearest possible indication that the shareholder v stakeholder debate is based on a false dichotomy. I propose that a new enlightenment must see the market price theory of value being replaced by what I'm calling the dignity theory of value. Dignity refers to inherent worth or inherent value. It refers to our own sense of dignity, our own sense of our own inherent worth, but it also relates to our sense of and respect for the inherent worth of others. Importantly, this idea of inherent worth, value, can also be applied to not just other people and societies, but also other beings, whether we're talking about animals, or it can be applied to the inherent worth of nature and the planet. So I think it's an extremely powerful concept and a far better way of thinking about value than using market price as a poor proxy for value. This is addressing what real value is to us as humans.
I'd like to describe three concepts which I think are really important to understanding how business has changed and how business has evolved. Because the thesis which I'm going to put forward in this presentation is to say that the terms in which we look at companies are still framed by that world of the mid-20th century, and that we need to think about it very differently. First concept I'd like to mention is collective intelligence. Collective intelligence, mediating hierarchy, and radical uncertainty. By collective intelligence, I mean collective knowledge in part. We know in aggregate much more than any individual knows. But more than that, we've acquired a collective problem-solving capability, which is that we are now able to build aeroplanes. Barely 100 years after the first aeroplane flew, we're now able to build aeroplanes of extraordinary complexity. And the remarkable thing about that is that there is nobody, literally nobody in the world, who knows how to build an Airbus, but 10,000 people working together do. That's what I mean by collective intelligence. Mediating hierarchy and radical uncertainty go together. These three concepts all go together, in fact. Radical uncertainty means we don't not just not know what the future will hold, We don't even know in many ways the kinds of things that the future will hold. And that's why the collective intelligence I've been describing has to evolve in ways that we can't predict, but as a result of the pluralism that permits small-scale experiment and cuts off that small-scale experiment if it fails, while arranging for it to be imitated quickly if it succeeds. That, for me, is the central basis of the success of our market economy. And that means that the successful organization, we've talked a bit in this discussion, perhaps too much rather, about leadership, because that implies that the successful organization is the product of the man at the top who knows and whose exemplary qualities and remarkable prescience enable him to build enduring businesses. That's not what a modern organization is like. It's better described in the terms used by Margaret Blair and Lynn Stout as a mediating hierarchy, in which it's not a matter of the man at the top making decisions, it's the matter of the people in the top ratifying decisions which have already emerged from the process of collective intelligence within the business. So it's these three elements of the overriding importance of radical uncertainty, the build-up of collective intelligence, the mediating hierarchy that have described the development of the kind of modern business we have today. The value of Apple essentially lies in what David Teese has called dynamic capabilities. It's the particular capabilities, the collective intelligence built in that organization, and the ability of that collective intelligence to adapt to produce a continuing series of different products. And if Apple's capabilities were not dynamic in that way, it would not remain a leading company for very long. This company, like the others which I've mentioned, is about as different from General Motors as it's possible to be. It's defined essentially by its collection of capabilities built on that collective intelligence. It's the aggregate of these. And actually, Apple's iconic product, the iPhone, is a powerful metaphor for that, in fact, because what the iPhone did was not to do anything new in terms of the individual facilities that were on the iPhone, the phone, the messaging service, the sat-nav, the camera, etc. What Apple did with the iPhone was to put together existing capabilities into a new package and a new concept. And that's actually typical of a successful modern corporation. And once we see business in these terms, and we see how unimportant capital is to these modern businesses, I'm about to say, I wish we would stop talking about capitalism, because it's a phrase that takes us back to models of business that have been out of date for half a century or more. And it leads us to think that modern business is about capital and finance in ways that it really isn't. The role of asset managers today is not to supply equity capital to business, because business doesn't raise equity capital anymore. The role of the asset manager is to undertake stewardship, and that involves, or doing that job properly, involves, in my perception, a much better understanding of the strategy of the business and rather less understanding of financial markets than we have at the moment. I wish the CFA courses would have rather less about financial markets and financial regulation and rather more about business strategy and business itself.
So we're talking about shareholders versus stakeholders. I'd like to bring another pair of S words into the discussion too, which is two curiously similar words that have very different implications in practice. One of them is the mantra of strategy, sustainable competitive advantage, and then the broader topic of sustainability. So certainly in the debate between shareholders and stakeholders, it seems to me there's a substantial level of agreement that we should be thinking much more towards the latter. It is actually possible to frame this as a false dichotomy because, of course, in the long run, if we don't meet the contextual sustainability needs of the business, if we don't think about stakeholders, then it may not actually be in the shareholders' interest. And one can give very real examples of this. So you may remember Turing Pharmaceuticals, Mr. Shrekley, who raised pharmaceutical prices by a factor of 50, created a backlash, went to jail. And this very profit-seeking behavior on paper may have appeared to be TSR maximizing, but of course was ultimately not in the interests of his shareholders at all. And it's not an isolated example. One can think about Valiant Pharmaceuticals that did something quite similar and was initially a great stock market success, but ultimately the very narrow profit-seeking behaviors were not in the interest of the shareholders of that business. However, I do think it's very useful to label this as a false dichotomy in the sense that I think in practice, a shareholder leaning business and a stakeholder leaning business are very different. So if you take the terabyte of data that constitutes how companies talk about themselves and how they betray their character, then some businesses are indeed very short-term oriented, very financially oriented, very mechanical in their analogies. It's about controlling variables that lead to profit maximization. They are largely concerned with internal matters, and others are much more longer term. They use more biological analogies. They're thinking about adaptation and learning and uncertainty and collaboration. They talk more about a purpose and they're more externally focused. The interesting thing is that the latter type of business are actually make more money. So it looks as if making money is a little bit of an oblique goal, to borrow the title of one of John's books, in that if your function is to, if your objective function is to try to maximize profits, you probably won't succeed in that aim. Profit maximization is probably best achieved by actually adopting larger, more oblique goals and having this as a byproduct. So some of those other things that we need to think about in addition to this one issue, one of them is how to fully integrate sustainability with strategy. So in my experience, we tend to somewhat separately optimize these two considerations. So we'll have a business plan and we'll have a CSR department or a CR department, which is concerned with measuring all of the ESG metrics and creating the sustainability report. And there is some degree of integration, but largely this is these are separate considerations. I think another problem that we need to solve is ways of balancing attention and resources across different temporal and social scales. So I think that sustainability is often framed as taking a long-term perspective, but the inconvenient truth is that there are trade-offs between different timescales, and we need to consider multiple timescales, and we need to think about those timescales. As a strategy consultant, essentially, I'd like to talk about how to reconcile and integrate these two separate considerations of sustainability and sustainable competitive advantage. So I have an idea that I call sustainable business model innovation for achieving this. And the idea is that we create a larger canvas for consideration of the strategy. So we expand the time scale and we say, we're not just talking about the next quarter or the next year, we're talking about that and the next decade. We expand the social scales to say, we're not just talking about the legal boundaries of the corporation, we're talking about the ecosystem, the broader society, and the natural ecosystem that the company is embedded in. And then on that canvas, we say, we're not just looking at value capture flows, cash flows into the corporation, we're looking at flows of externalities, trust. We're looking for all of the dynamics in the system. And we are asking the question, if we doubled the business, what would break first? If we double it again, what would break next? We're looking for the breakage points in sustainability of each company's unique competitive system. And then the idea is to apply a series of business model transformations or innovations in the business, which both create value and capture value in a sustainable manner. And the idea is that this would not be a one-off process. This would be an iterative process, because as one bottleneck removes and as circumstances change, there'll always be another one. So typically we think about the strategy of each corporation individually. We think about companies as economic islands, but it could be that some of our most complex collective problems cannot be solved even if we have optimal action at the level of each corporation. We may require better mechanisms for collective action. And the declaration of the Business Roundtable may not be a sufficiently strong form of collective action for the purpose. So one hopeful thought here is that 10 years ago, none of the world's 10 largest companies were digital ecosystems involving the collaboration of hundreds of companies. Now 7 of the 10 world's largest companies are multi-hundred company digital ecosystems with global reach. And one of the open problems of business is the governance of these ecosystems. They in some ways, they behave like mini economies. What rules should they be subjected to? And we can take obviously we can take an antitrust perspective on that and think about the restriction of the powers of these new economic aggregates. But another way to think about this as an untapped opportunity for collective action. And the technology industry, which is in our analysis destined to account for a very large proportion, drive a large proportion of economic growth moving forwards, is looking for social legitimacy, has increasing challenges of legitimacy, and therefore would, I think in principle, be very open to thinking about how can we better leverage these ecosystems towards collective action on our largest collective problems.
I've worked all my life in a Danish company, which is tremendously impacted by our social model of equity, of community, built originally on corporations, and the very well-known corporate model that we have is foundation ownership, where entrepreneurs that create businesses are allowed to give part of the ownership into a foundation while remaining owners. The foundation are still controlling corporations, but dividends are being funneled from the corporations back into foundations, which are serving a greater purpose than the individual shareholder purpose. And so I worked for 34 years in the same company, ended up as CEO. And now I'm the chairman of the main owner of the company that I worked for. And at the foundation level, we are giving back to societal purposes, philanthropy if you want, but clearly defined in our articles of association. So for me, it was never really a big debate about stakeholders versus shareholders. We were always obliged to look at our business in a long time perspective. And when you look at the business in a long time perspective, of course, you treat your employees decently, otherwise they go somewhere else to work. And especially as I'm working in a knowledge-based industry, these people can find work elsewhere. And so you would treat them and remunerate them decently you would treat your local community, you'd pay your taxes, you'd look after the environment, because otherwise you'd end up having regulation around your business. So for me, it was never really a complicated matter. Of course, there were trade-offs, as has been alluded to. There are some difficulties in defining how big is the trade-off on one dimension versus the other. If the company is in trouble, some issues become high on the agenda than others. But in general, at least I was brought up in a way whereby you have to take all these things into consideration when you make a business decision. Well, the ownership structure gave us somewhat of a leeway in that we were obliged to think long term, and the company were shielded from hostile takeovers, meaning that actually the foundation, through its ownership, controlled the company. And so, since the foundation obliges us to take long-term perspective, investing in science, investing in community, investing in serving our customers, of course, it was different than what my other peers were exposed to, and there were limitations as to what I could do in terms of mergers and acquisitions, because the foundation required a continued control.
So just reflecting on the conversations that have taken place in the conference so far, is there anything that you feel strongly you agree or disagree with from the statements and arguments that have been made?
Well, in the introduction, it was referenced the Business Roundtable statement that was made, I think, in 2019. And our institution is also a member of the World Economic Forum, and I attended the meeting where the World Economic Forum talked about a broader orientation of business, much more towards the stakeholder orientation. But I would have to agree with some of the scholars that have analyzed what it has amounted to in reality, that nothing much has happened on the ground and in reality. I see largely executive compensation being linked to shareholder return. There are some aspects of it which goes to diversity, inclusion, environment, social responsibility, but it's a small part of the compensation contract that I typically see in the companies where I'm on the board. And I was one of the interesting thing was that I think it was even mentioned in one of the previous presentations that not many of the companies that adopted the Business Roundtable statement actually went to their board of directors to seek an approval, which in a way is quite telling that they believed that there would be no change. Because if they wanted to have real impact and real change, they would surely have to go to the board of directors to seek an approval, because it would change the future of the company. So I think it is largely, I have to, and bear with me, I think it's a reaction to the future uncertainty that we are facing in business, that the business leaders can see that inequality, the lack of participation in the wealth created by globalization is leading to an dissatisfaction with corporate activities, the climate, other externalities that has escaped the responsibility from businesses, and so I think it's a way to try to deflect that criticism, but in my view, for most companies, without any real action.